Good evening, one and all. I am here to present the concepts and issues relating to TDS on transfer of immovable property. Well, coming to the background, tax is a fee charged by the government for an activity or an income for providing the infrastructural facilities to the civilians. Taxes are of two kinds, direct taxes and indirect taxes. When the tax burden can be shifted in the case of indirect taxes from incidence to impact, it cannot be shifted and it should be borne where the incidence and also impact lies with the same person in direct taxes. We all know that indirect taxes have examples of excise duties, customs and sales, service tax, VAT, etc. And regarding to direct taxes, it is income and wealth tax. And also corporate tax is one kind of direct tax where it is paid by the only companies. The important thing is collection of taxes by the government. When the government is going to collect the taxes only at the year end or once in a year, it is very much difficult to maintain and to smoothen the activities in the whole year of the government. So it decided to collect the taxes in three ways. One is advanced tax, and another one is assessed tax, and finally tax deducted at source. When we deal with advanced and assessed tax, and later we come to TDS. Advanced and assessed tax, though they both are similar in nature, assessed tax is paid at the year end at the time of self-assessment after the earner has all details regarding his income and his earnings. Whereas advanced tax, it is to be paid in the meanwhile of the year before finishing his calculations and computations just by estimating his all annual activities. Well, these both two are earner centric, that is the earner has to pay the taxes after calculating or before calculating his income and activities. But TDS, it is completely different from these both two. TDS is source centered. The important word is source centered. Tax should be deducted at the time of payment or at the time of credit by the source. The person responsible for the source of the income has to deduct this tax and has to deposit on behalf of the earner to the government. And coming to our provision, section 194IA deals with the TDS on transfer of immovable property other than agricultural land. Agricultural land as defined in section 2 subsection 14 class 3, and we all know agricultural land is not a capital asset and it doesn't attracts the capital gains provisions also, and in the similar way section 194IA is not also applicable to that. There is two more important provisions that we have to see before going to section 194IA. They are when the annual information report is to be submitted by sub-registrars or registrars, they have to submit whether non-quoting of PANs or invalid PANs quoted in the transactions in more than 30 lakhs regarding the real estate industry. And also section 139A says PAN quoting is mandatory regarding transactions of immovable properties of consideration exceeding rupees 5 lakhs. Though these two provision streams is stringent, there is lot of tax evasion in the real estate and construction industry. So to curb these practices, the then Finance Minister Sri B. Chidambaram introduced section 194IA. At the time of introduction, he said that section 194IA will improve the transparency and also will improve the presentation of the transactions in relation to real estate industry. Thus, the motto of the lawmaker, we are able to understand that to curb the tax evasion practices in the real estate industry, section 194IA is introduced. The section reads like this. My dear friends, mind you once again, the application of section is wholly dependent on the words present in the section itself. The section reads like this. Tax should be deducted on the consideration paid by transferee to the resident transferor at the rate of 1% only when the consideration exceeds 50 lakhs. At the time of payment or giving credit to the transferor. And there are 5 major issues in this provision itself. Let us see one by one. First thing is resident transferor. Why is it only dealing with seller as resident? Why shouldn't it be a non-resident seller? Because section 195 deals with section 195 deals with non-residents particularly. So there is no need to again produce the non-resident in this transaction. So section 194 IA particularly says that the seller must be resident, and when the seller sells any immovable property, section 45 is applicable and capital gains tax should be paid. For the purpose, TDS is introduced to deduct the capital gain tax at the time of transaction itself. And the important thing is transaction value. The rupees 50 lakhs is a threshold limit but not a basic exemption limit. What do I mean is, rupees 50 lakhs is a criteria to check whether the transaction is liable for TDS or not. That's it. But it is not like a basic exemption limit of 2 lakhs or 2,50,000 as in the case of individuals while paying the tax. For example, if the transaction value is 42 lakhs, TDS provision section 194 IA not applicable. If the transaction value is 51 lakhs, then TDS provision is applicable, and at the rate of 1%, TDS is to be deducted on whole of the consideration. On 51 lakhs, 1% amounts to 51,000. It should be calculated in this way. It shouldn't be calculated as if the 50 lakhs is exempted and on 1 lakh 1% 1,000. It should not be like that. It should be understand on the whole consideration 1% is leviable. And the third thing is time of deduction. The section itself said the time of deduction. What is the time of deduction? At the time of payment or at the time of giving credit to the resident transferor is the time for deduction. Mind you, my dear friends, when there is a capital gain section 45, we have to check out the date of transfer section 247. But section 2 subsection 47, the date of transfer is of no relevance in relation with 194 IA, because the time for deduction is already specified in this section 194 IA. It should be, if it is an advance payment, it should be deducted at the time of advance payment, or if it is giving credit to the transferor, it should be deducted at the time of credit to the transferor. Thus, time of payment is clear. And we have seen these three issues majorly, and the rate of tax as usual is 1%. And the final thing is the effective date. Section 194 IA has been with effective from 1st June 2013, and the transactions, if any, entered before 1st June 2013 doesn't attract section 194 IA provisions. I mean to say that A Limited and B Limited has been entered into a transaction in 2013 April for the purchase of property valuing 1 crore, but the payment has been made in 2014 April. Similarly, the transaction has been entered in April 2013, so it does not apply the provisions of 194 IA. It is clear with this provision. So, after having the knowledge of the provision, we have to check out what are the procedural aspects that is related with this TDS. Well, with regarding the TDS, the procedural aspects are very simple. First, we have to deduct a TDS, we have to deposit with the government, and we have to get the form of deposit, that is TDS certificate, and finally we have to observe what are the consequences of these all if you not comply with these provisions. First thing, deduction. If it is not deducted, what will happen? Interest at the rate of 1.5% per month or part thereof shall be leviable on the amount of TDS for the period of not deducted to deducted. I mean to say, the transaction took place on March 20th. That is, the credit has been given to transferor on March 20th, but the amount has been paid on April 20th. The TDS was deducted on April 20th. According to provision, what we should do? On March 20th itself, we have to deduct TDS. So he has not deducted TDS for the 1 month period. What happens? 1.5% per month has been levied on TDS as interest. That's the case of non-deduction. When after deducting TDS, what we should do, we have to submit that, or we have to remit that amount into government account. What if we doesn't remit it to government? Interest at the rate of 1% is leviable per month or part thereof for the period from deduction to non-payment into government. Notification 39/2013 has very much importance with relation to section 194 IA, that is it is a special notification particularly notified for this provision. Notification 39 speaks like this. There are four important aspects in section notification 39. One is with regarding to time of TDS return and form of TDS return, TDS certificate, and finally the TAN number related with the transferee. Mind you, my dear friends, all other TDS provisions are applicable to tax deductors. It is clear, but tax deductors should possess tax deductors account number, that is TAN, to deduct the tax from the deductees and to deposit. But section 194 IA speaks like this. In the notification, there is no necessary for TAN. PAN number is valid. PAN number is valid for deducting. And notification 39 of 2013 provides that form 26 QB, a special form of return of TDS, has been notified. What form 26 QB will contain? Only two PAN numbers. One is of buyer and another one is of seller. What is the transaction value? At what rate of tax is to be deducted? Are the only aspects that is contained in form 26 QB. And why is it different? We all know form 24Q1 is for salaries and form 26Q for all non-salary, but form 26 QB is particularly designed for this 194 IA. That is important. And the two things we have already seen, TAN number is not required, and form 26 QB is the return of TDS. What is the time for payment of TDS into government account? As usual, the payment of TDS in all other cases, and in this case also, the time for payment of TDS is 7th of the following month in which TDS has been deducted. That is, if tax is deducted on March, we have to deposit into a government account before 7th of the April or on the 7th of the April through Challan number 281, that we all know. And the special point here is notification 39 says that form 26 QB shall be submitted along with the payment of the tax. So as in all other cases of TDS, well, we file the return of income, return of TDS on 15th of the next month, after payment is made on 7th, there is a time gap of 8 months. In the 8 days, if the time has been given for these transactions also, there is a possibility of manipulating the transactions. So notification 39 says only at the time of payment itself you please furnish your return of TDS. So form 26 QB is a challan cum statement of TDS. It is neither challan nor TDS, it is both. So the form has been submitted. What happens after submitting the form? The credit will be got by the deductee. That is, the seller who has to pay the capital gains can avail the credit of the tax deducted by the buyer. So for claiming that TDS, what he must possess? He must possess a TDS certificate. As in the case of salary, TDS certificate is form 16. As in the case of non-salary, TDS certificate is form 16A. A special form has been notified through notification 39 for 194 IA. The special form is form 16B. What form 16B says? Form 16B doesn't say anything. It is just a certificate of TDS. That is, TDS has been deducted by the buyer in the name of seller. That's it. Form 16B also we have got. And last and final, form 26 QB is a special form that we can furnish only one PAN and one pan of buyer and one pan of seller only. I mean to say, where there are two buyers or three buyers or two buyers or three sellers, we have to furnish the return of TDS in the combination of each buyer and seller, that is M into N formula. When there is M buyers and N buyers, we have to furnish M into N returns. That is, one buyer and one seller is to one return, two buyers and one seller is to two returns, two buyers, two sellers is to four returns. That we have to understand. Why? Form 26 QB, when we see into tin.nsdl website, while furnishing or while payment, what happens? Only two pans is required. One is of buyer and another one is of seller. So it should be in each buyer and each seller ratio. When there is two or more buyers and two or more sellers, it shall be in the form of M into N returns. So that is clear with this procedural aspect. And one more thing, one more issue that arises is there is one seller and there are two buyers. One buyer has a proportionate of 60%, another buyer has a proportionate of 40%. As the transaction value is 70 lakhs, they both get 60-40, which is less than 50 lakhs for each. And what happens? Section 194 reads like this: the consideration should be taken but not the proportionate value of each buyer. So on the whole 75 lakhs TDS is applicable, but but we cannot deny that only buyer 1 has some amount, buyer 2 has some amount which is less than 50 lakhs, so they don't want to deduct a tax. It is not the criteria. Only criteria is whether transaction value exceeded 50 lakhs or not. That is one more important issue related with this. And section 194A and notification 39 of 2013 are of very much important in these future days, because the whole real estate and construction industry has been working with various provisions. This will be one of the major steps taken by the government to curb the tax evasion in these points, in this industry. Thanks for giving this opportunity.